Hi, and welcome to the Early Retirement Roadmap Podcast, the show where I help you prepare for and design a life you love after work. I'm Mike Upland, an early retiree at age 55. Now, today we're diving deep into something that might make your eyes glaze over, like it does for me, taxes. But stick with me because the decisions you make about your retirement account withdrawals could mean the difference between a comfortable retirement or constantly worrying and thinking about money. Before we get into it, let me be clear that what I'm sharing today is based on my personal experience and research. While I'm excited to share these insights with you, this is for educational purposes only. Everyone's situation is unique, so be sure to consult with qualified financial and tax professionals. Back to our topic. To illustrate how it's critical to plan for and be strategic regarding your retirement withdrawals, let me tell you a story about Bob and Linda. Now, they had done everything right. They saved diligently for retirement, built up a nice nest egg across different accounts, and were ready to enjoy their early retirement. But in their first year of retirement, they made a mistake that cost them thousands in unnecessary taxes. They withdrew $80,000 from their traditional IRA all at once to pay off their mortgage, thinking it would simplify their finances. What they didn't realize was how this large withdrawal from only their IRA created a large tax consequence that if they were more strategic, they could have avoided. Today, I'm going to help you avoid their mistake and share some critical withdrawal strategies that could save you a fortune in taxes. And I'll come back to how Bob and Linda could have saved thousands with a different strategy. Let's talk about something crucial for those of us in or approaching retirement: developing a strategic withdrawal plan across your different retirement accounts. Now, many retirees make the mistake of withdrawing from accounts randomly or based upon which one has the largest balance. But being intentional about which accounts you tap and when can save you thousands in taxes over your retirement. Think of your retirement accounts like different tools in a toolbox. You have your traditional 401ks and IRAs, where every dollar you withdraw counts as ordinary income. Then there are your Roth accounts offering tax-free withdrawals. And finally, your taxable brokerage accounts, where you'll pay long-term capital gains tax, which is taxed at a lower rate. The key isn't just having these different accounts. It's knowing how to use them together strategically. For instance, many retirees benefit from a combination of withdrawals that keep them in a lower tax bracket. For example, you might take some money from your traditional 401k or IRA up to the top of the 12% tax bracket, then supplement additional spending needs with tax-free Roth withdrawals or long-term capital gains from your brokerage account, which might be taxed anywhere from 0 to 20% depending on your total income. Going back to Bob and Linda's situation, instead of taking that $80,000 all at once from their traditional IRA, they could have taken $40,000 from their traditional IRA and $40,000 from their Roth IRA. This would have cut their taxable withdrawal in half. Even better, they could have spread the traditional IRA withdrawal across 2 tax years, taking $40,000 in December and another $40,000 in January, keeping themselves in a lower tax bracket each year. Now let's talk about required minimum distributions, or RMDs. This is where things get really interesting, and it's something that catches many retirees off guard, and it's certainly something that, honestly, I have to figure out yet for myself that I'm not excited about, but I know it's necessary for me to do so. Once you reach age 73, the IRS requires you to start taking distributions from tax-deferred retirement accounts like 401ks and IRAs, accounts that reduced your taxable income while you were working, but have grown tax-free over time. And required means just that. You must take these distributions even if you don't need the money. Skip or under-withdraw them, and you'll face a painful 25% excise tax, a steep penalty on the amount you should have withdrawn. Let me show you why this matters with some numbers. Let's say you have $1 million in traditional retirement accounts when you hit 73. Based on the IRS life expectancy tables, your first RMD would be $37,736. That's money you have to take out and pay taxes on, regardless of whether you need it or not. What many people don't realize is that RMDs can create a snowball effect on your overall retirement income. They might push you into a higher tax bracket, increase your Medicare premiums through IRMA, which is the income-related monthly adjustment amount, and cause more of your Social Security benefits to become taxable. And speaking of Social Security benefits, let's talk about how your retirement account withdrawals can affect their taxation. Did you know that up to 85% of your Social Security benefits could be taxable depending upon your other income? Here's how it works. The IRS looks at your combined income, which is your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits. For married couples filing jointly, if your combined income is under $32,000, your Social Security benefits are tax-free. Between $32,000 and $44,000, up to 50% might be taxable, and above $44,000, up to 85% could be taxable. Let me walk you through a real-world example to make this crystal clear. Suppose you're a married couple filing jointly with $30,000 in Social Security benefits, $40,000 from a 401k withdrawal, and $5,000 in tax-exempt municipal bond interest. Here's how the IRS calculates your combined income to determine how much of your Social Security benefits are taxable. They would first start with your 401k withdrawal of $40,000, then they would add your tax-exempt bond interest of $5,000, and then finally, they add half of your Social Security benefits, which would be $15,000. That's 50% of $30,000. And 50% because the IRS only includes 50% of your total Social Security benefits in combined income. This rule prevents full taxation and provides some tax relief for lower income retirees. But anyway, this gives you a total combined income of $60,000. Since this amount is well above the $44,000 threshold for married couples filing jointly, up to 85% of your Social Security benefits can be taxable. In this case, $25,500 of your Social Security benefits which is 85% of $30,000, would be included in your taxable income. Now imagine if you structured your withdrawals differently. For example, withdrawing $20,000 from your 401k and $20,000 from your Roth IRA instead. Since Roth IRA withdrawals are not included in combined income, your new combined income would drop to $40,000. This could significantly reduce the taxable portion of your Social Security benefits, potentially bringing it down to at most 50%. So this is an example of the power of strategic withdrawals in retirement planning. So let's break down a smart withdrawal strategy that takes all these factors into account. First, start with your taxable accounts. When you sell investments you've had for more than a year, you'll pay the lower long-term capital gains tax rate, which could be as low as 0% depending on your income. This is especially valuable in your early retirement years when you might be in a lower tax bracket. Second, consider withdrawals from traditional IRAs or 401ks. Every dollar withdrawn from these accounts is taxed as ordinary income, so the goal is to withdraw enough to meet your needs while staying within your target tax bracket. This is where careful planning really pays off. A common strategy is to fill up lower tax brackets with withdrawals, but stop before hitting the next bracket, preventing unnecessary tax increases. Third, tap into Roth accounts when needed. Since Roth withdrawals are tax-free, they're ideal for avoiding higher tax brackets if additional income would push you over a threshold. They also help with minimizing your Social Security tax exposure by keeping your combined income lower, and they can help to fund large one-time expenses. For example, Bob and Linda could have used their Roth IRA for their mortgage payoff without triggering extra taxes. By strategically combining withdrawals from these accounts, you can minimize taxes and make your retirement savings last longer. Another way to reduce taxes in retirement is through Roth conversions. This strategy involves converting portions of your traditional retirement accounts to Roth accounts during low-income years. While you'll pay taxes on the conversion now, it can save you money in the long run by reducing future RMDs and providing more tax-free withdrawal options later. Here's another powerful but often overlooked strategy: charitable giving directly from your IRA through a qualified charitable distribution or QCD. Once you turn 70 and a half, you, and if you're married, both of you, can donate up to $100,000 a year directly from your IRA to qualified charities. These distributions count towards your RMDs but don't increase your taxable income, helping you manage your tax burden while supporting causes you care about. QCDs are only available from IRAs, so if you have a 401k, you would need to roll over funds to a traditional IRA first to take advantage of this strategy. By incorporating Roth conversions and QCDs into your retirement strategy, you can gain more control over your taxable income and reduce taxes on your Social Security and other withdrawals. Now let's talk about action steps. First, calculate your expected expenses for the year. Break these down into fixed expenses such as groceries, utilities, and so forth, and discretionary spending such as travel, entertainment, and hobbies. This gives you a clear picture of how much you'll need to withdraw to cover your lifestyle. Second, review all your accounts and their tax treatment. Know exactly what you have and where. This includes traditional IRAs, Roth accounts, 401ks, and taxable brokerage accounts. If you have appreciated securities and taxable accounts, consider strategies like tax loss harvesting or capital gains harvesting for tax-efficient withdrawals. Third, project your tax bracket based on planned withdrawals. Factor in all income sources, including Social Security, part-time work, rental income, pensions, and dividends. This helps you identify opportunities to stay within your target tax bracket and avoid unnecessary tax jumps. Fourth, optimize withdrawals to reduce Social Security tax exposure. If you started collecting Social Security, consider adjusting your withdrawals. Sometimes withdrawing less from traditional accounts and more from Roth or taxable accounts can keep your combined income lower, reducing how much of your Social Security is taxed. And then fifth, plan for required minimum distributions if you're 73 or older. By taking these steps, you can maximize tax efficiency, keep more of your retirement income, and help make your savings last longer. Before we wrap up, remember that while these strategies can be powerful, tax planning is complex and personal. Always consult with a qualified tax professional about your specific situation. So that's all for today's episode of Early Retirement Roadmap. If you found this information helpful, please leave a review and subscribe wherever you get your podcasts. Until next time, this is Mike Upland from Early Retirement Roadmap, helping you navigate the path to financial freedom. Take care and make the most of today.